let me also welcome on board Karthik Kumar, Fund Manager at Axis Mutual Fund, joining us on the show. Hi Karthik, good afternoon and good to be speaking with you. And firstly, help us with your broad take on the markets right now, because now it seems like that the excitement is back in the markets with this GST announcement, good GDP numbers. The earnings were also not that bad. Seems like that the markets are factoring in. But the question is, where are we headed from here on?
Good afternoon. Thanks for having me. As I said, since we heard about GST restructuring, the markets has taken things quite positively. I think from here on, what will decide the course of the markets is to what extent we see a pickup in consumption, and those are the data points we'll look out for increasingly in the festival season, given the cut in GST as well. So that's something the market will watch out for. And second thing is, if we do get any positive signs in terms of the tariffs and the ongoing negotiation with US, that will be another added fillip to our markets. But those are the areas that we'll be looking at in the short run. Having said that, the market is structurally positive for the long run for a couple of reasons. One is that we've underperformed emerging markets quite significantly now, as a result of which our valuations are in line with longer term averages. Valuation premiums to emerging markets are in line with longer term averages. So while our market might not be attractive in absolute terms, in relative sense, it looks reasonably placed from a valuation standpoint. Second is that while the earnings season was tepid, and we did see earnings cuts to FY26 post the earnings season, the extent of the cuts have gone down. So, for instance, in the first quarter, the earnings cuts were close to 3%. Post the results last quarter, the earnings cuts were only around 1.5%. So we are seeing a decrease in the intensity of earnings cuts as well. So I think all those things augur well from a structure standpoint for a medium to longer run.
And Karthik, hi, afternoon. This is Nehi also joining in. And you started your answer by talking about the GST rationalization. And of course, that is the big fillip that the market has been waiting for. But on the back of that, is the overall consumption pack looking more attractive to you? Or are you going to be waiting till the benefits they actually start kicking in? Or have you already, positioned your portfolio to take full advantage of that?
I think it comes down to sectors and subsectors. So, for instance, in some cases, a cut in GST could actually help aid volume growth. In some cases, in some industries, it may not be as elastic as one would think. So in those areas or in those subsectors, the GST cut might not necessarily incentivize volumes. But in our case, we even prior to GST, we were bullish on, let's say, value retailers. We were bullish for hotels, tourism. Those are areas that have a structural tailwind. And given what has happened with GST restructuring, I think that just adds to the thesis. So those are areas that we are already bullish on.
Right. So Karthik, what is it that you're doing in your funds right now? What are the biggest overweights and underweights?
So from an overweight perspective, as I said, we are bullish some of the consumption, more discretionary oriented themes that I mentioned before. Aside from that, we are overweight power, T&D, telecom, and financials, largely across the board. Slightly selective within capital market themes, but otherwise we are bullish financials. Those are the sectors that we are bullish on. And from a style perspective, if we look at it, I think given when the markets start seeing when we start seeing an uptick in earnings, wherein the next 12-month earnings or so starts trending positively rather than the slight negative revisions that we are seeing right now, I think the focus will be back to growth, and growth style in conjunction with quality kind of looks good over the medium to longer run.
All right, so those are some overweights in the portfolio that Karthik just talked about. But other than that, Kunal, one of the newsmakers today is actually L&T, and wanted to have a chart check by you because just today the company announced a new order win, which was decent enough. I think it's over 1,000 crores, but just yesterday they announced an order win of more than 2,500 crores in the range of 2,500 to 5,000. But technically, a 2% move for a slow mover for L&T. What does it mean?
So I think this was due. This was like, as if a point where the index has moved up almost 700 points and L&T had not participated. In fact, L&T over the last, I think, 3 or 4 weeks prior combined to the previous week's price action was actually showing signs of negative price correction. The stock had corrected from 3,700 to I think 3,500, 3,550 thereabouts. So statistically, we've seen L&T is one of those stocks on the large cap Nifty 50 basket, which has a much higher correlation with respect to its, I'm not saying immediate sector peers, but the overall index peers. So I think with a correlation of more than 75 to 80% in many instances. So I think in that context, L&T is trying to play a good catch up, something which I think other large cap stocks like HDFC Bank and Reliance have still yet to do in that same price intensity. What this also brings in for L&T at this 36, 60, 70 levels for the stock is now, we are spotting an inverted head and shoulder pattern for the stock on the line chart. And I think if the stock manages to break past about this 3,700 barrier, we could be looking at a further up move of at least another 100 points on the upside. So an initial start to a short-term breakout has happened, but the second breakout could happen once the stock breaks about 3,700 mark.
Okay, so that's a chart check on L&T. Time now to slip into a very short break. We'll keep the conversation going with Karthik and Kunal on the other side.